Hello and welcome to Deal Flow, the show that explores the world of mergers and acquisitions. I'm Erika van der Merwe. We're focusing this week on M&A opportunities in the agriculture sector in South Africa, as well as in the African region as a whole. Now, the continent holds enormous potential for increased productivity in agriculture and agri-processing, with large swathes of arable land available to feed our population as well as the population of other world regions. So we ask what the deal flow trend in the sector has been, what types of deals are being structured and how they are being structured. We start with an update from Timishu on some of the deals making news this past week.
Thanks, Erika. Now, a quick look at those deals. Beijing Capital Group will buy the biggest waste management firm in New Zealand from Australia's Trans-Pacific Industries Group Limited for almost $800 million. Now, this will enable the Chinese state-owned company to acquire technology that could help combat chronic pollution. And in other deals, HSBC said it is in talks to sell its business in Pakistan to Mizan Bank, another possible sale by Europe's biggest bank from countries where it is unprofitable. And finally, Yandex, which is Russia's largest search engine, said it has entered into a partnership with Google that will allow their clients to tap into each other's advertising inventory. Well, those are your deals. Back to you.
Investment in agriculture is experiencing notable growth in many world regions. It's a sector notorious for price volatility, government intervention. But as the world population swells, the opportunities are growing too. Ernst Janovsky is head of Absa Agri business. And in our Cape Town studio, we've got Celliers, CEO of Zeder. Welcome to both of you. Really good to have you here. Ernst, if I start with you, so if you look at deal making in the agricultural sector, so it's pretty broad, and I would imagine there's a fair amount of vertical integration that can take place here. There's elements of land ownership, there's elements of owning the assets, of the processing assets, agri-processing and food, and then the logistics element. Given my introduction, are you indeed seeing a pickup in the volume of deal flow in these areas in South Africa, but across Africa?
Erika, yeah, I think what we must do is first classify, just look at South Africa quickly. If you look at the primary sector, there's a huge deal flow currently taking place. There's a lot of consolidation taking place. We were 35,000 farmers. Recently, we predict that we're going to be about 7,500 commercial farmers in 2040. So if you really just look at that type of scenario, there's a huge amount of deal flow coming through. But there's also a lot of things happening in the sense that farmers, as they become bigger, they become vertically integrated into the process. They're either doing some processing or they're starting to be almost like a co-op themselves. So that puts the whole old co-op structures or agricultural companies that supply input supplies into the industries under pressure, and their profit margins are squeezed. So we can expect also a lot of consolidation taking place in that whole scenario around that. And then there's, of course, the integration, the vertical integration, producing the poultry that's going to be sold into the pick and pays itself. I think there's a lot of consolidation also taking place in those industries. And because of profit margins being squeezed currently quite a lot in terms of certain industries, we can expect in that specific industries to get efficiencies out of it, that a lot of deal flows are taking place. Yeah. And then, of course, unfortunately, land is limited, and that's the production capacity which you see in South Africa. So if you want to expand as a primary producer, and you get to start looking over the borders. So we see a lot of things happening over the borders, some huge investments taking place from South Africa going there, and it's not so much new enterprises being generated there, but it's got one foot in South Africa, one foot in Africa, yeah. And we see that whole development continuing to grow, and it's actually leveraging the South African balance sheet to finance what you're doing in Africa. We see quite a lot of that also happening.
So Norman, where Ernst, to my understanding, is he services the South African agri-industry. You do deals in the South African agri-industry and also looking northwards, as I suspect Ernst is doing from his vantage point. Do you agree that this is what you're seeing? We're seeing consolidation and further prospects for consolidation in the whole vertically integrated agri-chain, and also this trend of South African-based businesses diversifying operationally north of the border?
Yes, I think we're definitely seeing a lot of activity in this space. Zeder, for example, we're an investor, and we make investments across the board, both South Africa and outside of our borders. And we'd like to find companies where management teams are in place and existing businesses have got the ability to grow. Where we like to look at mergers and acquisitions is from the point of view of one of our portfolio companies or existing operating entities. We think that many people forget the fact that mergers and acquisitions work because of people and synergistic benefits afterwards. So the reason why South African companies are increasingly moving into Africa is they believe they've got people and core capabilities that they can expand across the border. Other than that, you would find often that a lot of the transactions are asset-based or project-based transactions. If you don't find a good company out there with good management in place, it's better that you buy something that your core South African operation can take ownership of and take control of, and you've got the benefit of those processes that you understand.
So Norman, in this latter part of your answer, you're talking about processes, and so what I'm hearing there's the agri-processing side. Do you do deals more on sort of the land ownership side, that where access to land, to productive land, might be an issue for you?
No, we're an investor and we will look at any opportunity. So if we find a primary agricultural opportunity that we believe there's a competitive advantage in, for example, the investment that we've made in Zambia, we will invest in those projects. But we may, for example, decide not to invest in primary agriculture where we feel it's oversupplied and very low margin and asset intensive. We will then look across the entire value chain. In the processing sector, we'll take the same approach. If we feel that the market allows for increased margins because it's in a developing country and it's not oversupplied, we will be very interested in those investments. But we don't categorize ourselves as playing in one particular link. We look across the entire value chain and we find value-enhancing opportunities accordingly.
Ernst, if you look at the South African deal-making environment, it's very much a case of many South African firms only now exploring opportunities north of the border. We had a first wave several decades ago, and we're seeing that second wave now. Now, aside from the typical concerns and considerations one needs to bear in mind when doing transactions in other countries, if you look at the agri and agri-processing industries, what other considerations are there?
Look, if you really want to go into Africa, you've got to think a little bit differently than in South Africa. Normally in South Africa, you would say there's an asset base, which is the land. Normally, you'll either finance the production side of it, or you'll contract in that asset into your business, and you'll utilize that offtake into your processing plants and whatever the case might be. In Africa, it's a little bit different in the sense that more than 80 or 90% of everything that's been produced is small scale. So what you'll have to do is you have to think about, how do I bulk this? How do I get this into a factory that is big enough so I can actually start utilizing this on a more competitive basis at the end of the day? And unfortunately, the one thing that was hampering Africa to a large extent up to now was the infrastructure side of it. In other words, there was no spend on roads, there was nothing else done. So at the end of the day, you can't move your product. Now all of that is taking place. For the last 11 years, if you really look at Africa and you see how much has been spent on roads, how much in power lines that's been built, dams that's been built, all of that infrastructure is the given now for the takeoff for agriculture to start producing. But it's still early days in Africa. So if you look at it from what that side is, you'll look at what the infrastructure is. You'll also look at the political risk side of it, because political risk is really one of the risks that you are still open to. And especially if you start producing something like maize in Zambia, for argument's sake, and all of a sudden government comes in and says, well, I've got to protect my small scale farmers, so I'm going to control the price. As soon as that control comes in, it tampers with the profitability of that specific enterprise. So you'll have to look at political risk in this whole scenario. Ease of how easy is it to do business in that specific country. So all of these things you'll have to take into consideration. If you just look at the climatic side of it, of course, Africa is open. That's where you want to be. It's got the soils, it's got the rain, it's got everything you want in terms of from a climatic and a natural resource side of it. But it's the infrastructure side, and then the political risk, and then access to how can I do this business.
Norman, I'd like to hear your perspective. So when you are doing your due diligences or building your deal flow pipeline in African countries outside of South Africa, what does your tick box look like? The factors that Adam's mentioned, land ownership, certainty of land ownership, intervention by governments, but also on the flip side of the huge sort of climatic potential.
No, I couldn't agree more. Huge climatic potential, but to be honest, Africa's had potential for centuries and centuries. The problem is Is it easy to do business? Do the investments get respected? And is there a measure of free market forces at play that you don't have to be worried about interference? Those are very, very important matters. So when we approach Africa, we take two views. One is trading with Africa or African countries, and the other one is investing. And when we trade, to be honest with you, it's an easier decision. We trade and try and do business all across the continent. But when we go and invest, we do spend a lot of time taking these factors into consideration. We engage with local government. We make sure that we've got the right local partners. We ensure that whatever our activities are on the ground, that it's done in such a way that it's sustainable and that it complies with the local laws. So it is very important to take those things into consideration. And as a result, the countries that come out easier for us or more attractive are the countries where banks and law firms and infrastructure companies are already reasonably established, and it actually reduces the potential volatility that can come with political interference. Having said that, to be honest, all the countries that we do business in outside of South Africa have got some element of risk, but I think our own country and other countries around the world are displaying similar concerns and protection approaches that business is tough everywhere. But I think Africa's got enormous potential and opportunities, and it's worth taking the risk and going in.
Norman, we've run out of time, but I just want to put a quick question to you. If you look at your revenue by source, so if you look at your African revenue excluding South Africa, where are you now as a generator of revenue, and where would you like to be in 5 years' time?
Look, firstly, again, we're an investor, so I'm speaking on behalf of our portfolio companies. I would say that our portfolio companies currently generate about 60–70% of their revenue in South Africa and 30% outside of South Africa. Of that 30%, I would say 50% is Africa and 50% is the rest of the world.
And it's a quick question just to bring it all together. Presumably you're seeing your clients taking similar steps to this investment house and also the underlying portfolio companies expanding operationally.
Look, what we do is we tend to follow our clients into Africa. I think that's the easiest route, because at the end of the day they need transactional and they need finance in this whole process. So that's what we tend to do, is follow our clients. Normally we leverage the South African balance sheet because land is, although you've got access to land, it's not to say you can use it as security. So at the end of the day, that's what we do currently, is follow our customers into Africa, and it's starting to pay off.
Well, Ernst and Norman, thanks for your time and your insights. My guests were Ernst Janovsky, he's from Absa Agri Business, and Norman Celliers, he's CEO of Zeder. And that's a wrap for this week's edition of Deal Flow. Until next week, it's goodbye.